Today we're going to be talking about Beanstalk and the path forward. So many of you remember that Beanstalk was a crypto protocol that was recently hacked. At least a lot of people have called it a hack. In one of my previous videos, I called it a Beanstalk crypto hack. It's not really a hack as much as an exploit, meaning that the code wasn't broken. There was no bugs in the code. Someone used the code as intended and they exploited it. So let me give you an example. Those of you that are familiar with how Bitcoin works, if someone were to complete a 51% attack on Bitcoin, that would be an exploit. The blockchain operates as intended, but you could still do a 51% attack on it. The reason no one does that on Bitcoin today is because it would take more money than most governments on the planet have access to be able to buy the computing power to pull off a 51% attack. Beanstalk would have got to the place that would have been very difficult to pull off the exploit that the perpetrator pulled off, but it was flash loan attack. I did a previous video talking about what happened. I'll link that above if you want to watch it, but they have a plan to move forward. I'm very excited about this project because what they're doing, they're creating an algorithmic stablecoin and they're using some mechanisms that appear to fix some of the common problems other algorithmic stablecoins have had in the past. And we'll talk about that towards the end of the video when I explain how Beanstalk works. But I want to talk about what they're going to be doing going forward. And I want to kind of share my thoughts with you. Announcing the barn raise, a public 10-day fundraiser to restore Beanstalk. So Beanstalk is a decentralized and transparent solution to DeFi's endemic stablecoin supply shortage. It was designed from first principles to be a paradigm-shifting DeFi primitive that makes decentralized, cost-effective stablecoins available to anyone with an internet connection. Beanstalk was initially launched on August 2021 with just 100 beans and has never taken traditional funding. This thing bootstrapped all the way from essentially $100 worth of value on the protocol. Over the last 8 months, Beanstalk organically grew to $100 million in market cap, attracting $144 million in long-term incentivized liquidity. Until the on-chain governance attack on April 17th, Beanstalk's model was working exactly as designed. During the 2 weeks prior to the attack, the protocol paid, get this is in a 2-week period, the protocol paid $25 million back to creditors, reaching a total of $50 million paid back since Beanstalk's inception. It distributed $25 million in interest to depositors in the silo. This is why this thing has been so lucrative, the interest it was able to pay out. It has attracted $110 million in new liquidity across 3 liquidity pools and reduced the protocol's total debt ratio by more than 50%. And ladies and gentlemen, this was all within the 2 weeks before the exploit. From day one, the protocol has been owned solely by members of the Beanstalk DAO. Now, when they say DAO, they literally mean a true decentralized autonomous organization. This thing from day one was a true decentralized project on the blockchain. This is not one of those projects pretended to be decentralized, but it was really centralized. This was truly decentralized from the get-go. A lot of people, when they ask about algorithmic stablecoins, they ask questions like, what's the difference with USDT and USDC versus Luna and the UST? Well, let me just say this. If you're asking the difference between USDC and USDT, stick around. We'll get stablecoins toward the end of the video. But when it comes to something like Luna, I'm a big fan of Luna. I like that project a lot. But that project is not truly decentralized right now. It is moving towards being more decentralized all the time. The Luna Foundation or whatever has had to bail out the UST token several times because it's lost its peg. That has not occurred with Bean until this exploit. So if they can get this thing back up and running and make it where it cannot be exploited in the same way again, we may really have a shot at having something here that can be truly revolutionary and I believe is necessary for the long-term mass adoption of cryptocurrency in general. Like, we need to see a stablecoin on the path to mass adoption. I genuinely believe that. So from day one, the protocol has been owned solely by members of the Beanstalk DAO via decentralized on-chain governance structure. Unfortunately, a bad actor exploited that very structure to steal all silo assets, including $76 million in non-Bean liquidity. This was an attack on Beanstalk's governance model, not its economic design. This is important. The economic design works, and for those of us who can be a part of it, potentially can be incredibly profitable for us. I'll explain the profitability a little bit more in a moment. Despite this hurdle, the Beanstalk community has emerged stronger than ever, and contributors are working around the clock and without pay to get the protocol back online. The Beanstalk Farms team has always said that if Bean is at peg, it's a good day. The community is ready to have a great day. So the actual barn raise, the way it will happen, just a quick overview. Beanstalk will host the barn raise, meaning the protocol, they're calling themselves. themselves Beanstalk, will host the barn raise, a public 10-day fundraiser to restore up to 100% of the $76 million of non-bean liquidity stolen from the silo. The barn raise will consist of 2 phases, a 7-day bidding period, this is important, followed by a 3-day sowing period. This fundraiser presents a unique opportunity for supporters to access a category-defining protocol at a seed-like stage while stepping into pre-existing product market fit, a proven team, a steadfast community. Any Ethereum wallet will be able to lend Beanstalk during the barn raise via the new barn raise pod line. There will be 76 million worth of soil available during the barn raise, meaning that a maximum of 76 million can be sown before the fundraiser ends. Okay, to clear up a couple of things. Soil is basically how many funds are we willing to make loans for. In this case, they need $76 million. So they're willing to repay back $76 million worth of funding. That's all the soil means. So what's going to happen in the first 7-day period? If you say, hey, I want to invest $10,000. Someone's going to say, I want to put $1 million in here. What they're going to do is they're going to be able to go ahead and commit the funds at that point. Once they commit the funds, then they wait until the 9th at 12 p.m. Eastern time. May 9th, 12 p.m. What will start happening is the weather, which serves as the interest rate, will start at 20%, meaning you can commit funds starting at 20% interest, and it will increase by 1% every 10 minutes for the duration of the sowing period, which will end after 3 days or when the soil reaches 0, whichever comes first. Bids that are not successfully filled during the sowing period will be claimable after Beanstalk is unpaused. Bids will be partially fillable as well. What this means is when you commit capital in the bidding period, you're also going to say, I want to get 20% interest. I want to get 50% interest. You could say, I want 200% interest, 400% interest, whatever the maximum multiplier is. If you do 20% and it goes up 1% every 10 minutes. So if I did my math right, if they go all the way to the end of the sowing period, potentially it could go as high as 1,000% or 10x. It's going to start at 20% and it's going to go up towards 1,000%. Now, it probably won't quite get that high because what you do over here in the bidding process is you say, hey, I want to put my $50,000 in and I want to get, at 300%. Well, during the sowing period, you have to wait to see if it gets funded before it gets to your 300%. So it starts at 20%, and then in 10 minutes it goes to 21%, 10 minutes more it goes to 22%, and it keeps going. Eventually, it will get to 300%. And if you got your $50,000 in there at 300%, then you will get that bid as long as it goes that high before it's getting filled. So understand, during the sowing period, nobody knows exactly how much each person committed or at what interest rate they're asking for. But if the interest rate gets there and they're not fully funded, then your bids will go in. At that point in time, when your bid goes in, you're going to be in a line to get paid back. And the protocol pays back over time. The one thing that none of us have control over is exactly when we get paid back. We get paid back as the protocol is able to pay us back. However, possibility of being able to make 300%, 500%, 1,000% on a protocol that is already proven to work, where people have been earning fantastically. I mean, there are people that have literally made 30, 40x. That's 3,000, 4,000% through this credit-based model. This is going to be incredible. I'm very excited to see this. I'm definitely going to go in on this protocol. After the sowing period concludes, there will be a brief interlude prior to unpausing Beanstalk, during which core contributors and the community will ensure that satisfactory governance and safety measures are in place. Once Beanstalk is unpaused, new bean mints will be distributed in a 1/3 allocation to each the silo, the existing pod line, and the BR pod line. The barn raise pod line, the existing pod line, will be repaid back on a first in, first out basis. Meaning, if your bid gets accepted first, you'll eventually get paid first. If your bid gets accepted last, you're probably going to have more interest because you were waiting longer, but you'll also get paid last in the pod line. After the barn raise pod line is completely harvested, the new bean mint schedule will revert back to the Beanstalk's original 1/2 silo and 1/2 existing podline allocation. Capital sown, meaning people who paid money during the barn raise, those funds will be used to reimburse stolen funds pro rata to the silo. The protocol will scale its obligations based on the amount of capital raised. This means that if X% of the 76 million is raised, participants will receive X% of their pre-exploit beans, stalk, seed, BDV, and pods. So in other words, just to keep it simple, let's just say that you had $10,000 invested in here and half of the 76 million is raised, you're going to get paid back on $5,000, not $10,000. Now, that's not necessarily all bad, because maybe you put in 4,000. In some cases, people still may get more than they originally put in. And it is possible if they don't raise the $76 million. I personally think they're going to raise all of this. I genuinely think they're going to raise all this. Again, this is a proven model that works, and people are getting paid significant returns. I mean, I could be wrong. Nothing in this is considered financial advice. I'm just a cryptocurrency YouTuber. If they get half of it or a third of it, then your assets, if you're already in, will get shaved by what percentage does not get filled on this platform. A lot of people were complaining about that, but the crazy thing is, had they not done this, the protocol could have died. So 50% of something is better than 100% of nothing. Silo members. Reimbursed Silo assets will be placed under a vesting schedule based on the percentage of the Barn-Raised pod line that has become harvestable. If Silo members choose to withdraw before the Barn-Raised pod line has been fully repaid, they will face a haircut proportional to the amount the Barn-Raised line repaid. For example, if a Silo member decides to withdraw all their assets from the Silo and 50% of the Barn-Raised pod line has been repaid, they will forfeit their right to 50% of those assets. Farmable beans earned from new minting going forward are not subject to this vesting schedule. You're going to be penalized if you try to dump out of the protocol right away. This is a current reiteration of the Barn-Raised opportunity. Governance is going to be on a multi-sig wallet for now, which means it's not going to be fully decentralized. They do plan to get back to a decentralized model. I mean, they're absolutely committed to that, which is awesome. They have taken some security measures. They talk about what they're doing to take security measures going forward to prevent this protocol from getting hacked again. The path forward. Beanstalk has always been an experiment. Contributors recognize a need within DeFi for a capital-efficient, decentralized stablecoin and set out to build it together. Beanstalk's innovative credit facility and incentive mechanisms are responsible for the protocol's growth to $100 million in market cap. Unlike every other decentralized credit-based stablecoin in history, Beanstalk's economic model has not failed. The Beanstalk Farms team is committed to carrying the torch for Beanstalk's mission in lockstep with the Beanstalk community. We believe that unpausing Beanstalk after a successful barn raise is the best path forward to achieve that goal. All right. So the next day or two, they're going to do a snapshot and people are going to be able to vote to confirm this path forward. There may be some changes. They're always up for adjusting whatever needs to be adjusted. I really think this is one of the fairest plans that I've seen. I'm actually excited. Like when someone gets excited about a launch of a project that was previously exploited, and there's a lot of excitement about this. It seems like there's a lot of big money talking. We'll see what actually comes in, but I think this is going to be incredibly, incredibly exciting, not just from an investment standpoint, but when you understand how algorithmic stablecoins work and you understand their use case and the fundamentals that supports needing a good algorithmic stablecoin, this is more than just being able to make money. You know, my channel is called Crypto Wealth. I believe in earning income in crypto, primarily because we are here early. We are here first. And the earlier you get in on something before it is proven, more risk, but also the more possibility of financial gain. And I believe that Beanstalk literally epitomizes that. Now, what exactly is the Beanstalk and how does it work? I'm going to give you a quick Beanstalk crypto tutorial and just really give you a tutorial showing you how the whole Beanstalk protocol works, how the Bean crypto works. And we're going to do this by first looking at something like Savannah. This is a typical algorithmic stablecoin. They're very risky, but you can make a lot of money with algorithmic stablecoins. I'll show you why here in a moment. However, they have some inherent flaws, and every single algorithmic stablecoin that has not had some sort of centralized assistance has ultimately failed, every single one of them. However, Beanstalk stands to potentially change this. So let's understand how algorithmic stablecoin works, and then I'll show you where Beanstalk differs to fix some of the problems that are common. So in this particular algorithmic stablecoin, the SVN token is pegged into a token called MMF. So right now, one SVN token is valued at $1.13. One MMF token is valued at $1.03, which means SVN is not 1-to-1. It's one SVN to every 1.1126 MMF. Right now, SVN is overpegged, and this is when these projects are very, very profitable. So you have the SVN token, which is designed to be pegged to something. Most often they peg to $1, by the way, but in this case it's pegged into another cryptocurrency, which is unique. But SVN is pegged to MMF. Right now it's overpegged. They have to expand the supply of the token, but what do? They don't don't just dump it on the market. That's not going to work. Theoretically, what they would do, they would give those extra SVN to people that are invested in the protocol who want to see the protocol succeed long term. In this case, it's the M shareholders. There's always a share token. There's a logic or a theory behind how this is supposed to work, and then I'll share with you what really happened. What's supposed to happen is the people who own the M share token, right now they're valued at $12,000 each, $13 million in this protocol. There's only 100,000 supply. The idea is if you own the M share token, then you must really believe in this. So they give you the SVNs as a reward. You basically get free money, and it's a lot of money. If you come over here to inside Oasis, or what they call the boardroom on an algorithmic stablecoin, if you had M share, you would stake them here. Every few hours you get your reward. The reward comes out to 2% daily, 732% APR. That's not a gimmick, by the way. The catch, if there is one, is that this M share price can go up and down radically. I think M share has been as high as 20-something thousand or $30,000. It can't ultimately go much lower. It can go down to a few $100s at some point if it wanted to. I think the lowest has been so far is $3,000. That's very volatile. But if you own the M share, then you make the rewards every epoch. Now there's another mechanism here. Everything's fine. That works well as long as we're above peg. But what happens if we fall below peg? Theoretically, the bonds come into play. You can buy bonds with SVN. You got to pull the SVN off the market. So if we're over peg, they put SVN back on the market and it goes to the M shareholders. And this is all done through smart contracts. If they go under market, let's say the SVN all of a sudden is selling for 90% of its peg value. Let's just say that instead of it being at 103, SVN is trading 93 cents or roughly 10% down. Then what would happen is you could use SVN and buy bonds. So you can buy bonds for 93 cents. That's what they would cost. And you would use SVN to do that. When you buy the bonds, you're burning the SVN, so you're decreasing the supply. Once it got back over peg, then you could cash in your bond. The idea being you'd make 10% on your fund. The ability to earn from in-share and to earn from bonds, in theory, should keep this thing pegged. So how come these never work, or they haven't worked yet without some sort of centralized authority? Because most often what happens is there's too much economic freedom here. There's a SVN price that can go up and down, meaning a lot of people can buy a bunch of SVN on the open market and it would take the price up. They can sell a bunch and it would take the price down. M share can go up or down. Bonds can go up or down. There's too many variables here that rely on human emotion. And I think that's exactly why they always lose their peg. Keep in mind, typically when the market starts dropping, people get fearful. They want to sell. So when SVN drops below peg, what's supposed to happen is people are going to want to buy bonds at current market value to be able to exchange them for SVN later. So the idea is using the SVN to buy bonds cheaply. The bonds will go back up in price in line with SVN, redeem those for profit once you get over peg. All too often, what happens once SVN loses its peg, when there's selling pressure, a lot of times what happens is everybody starts selling. And the bond buyers, if enough people don't come in and buy bonds, if they're fearful, and they don't know if it will go back up. And then it gets further and further away from its peg. Maybe it's selling for 90% of MMF, then it'll sell for 80% of MMF, then it's 70% of MMF. And when it gets further and further away from that peg, people just don't buy bonds. And if people are not buying bonds, then there's no way to regain the peg. And then the share prices dump and the whole thing basically collapses. And historically, there comes a point in time when this happens in almost every algorithmic stablecoin. Unless the team is standing by with additional funds to buy up SVN, they can extend the life of it for a while. But at some point, it tends to collapse. So Beanstalk is an algorithmic stablecoin, but instead of using M shares, it uses a credit model. This is significantly different for several reasons. One is it doesn't require bonds. When the token loses its peg and it drops below peg, bonds require brave souls to say, hey, I want to buy bonds because I think the peg's going to go back up. Psychologically, they have to make a buying decision for an asset as the price is falling, which is the exact opposite. In crypto, the idea is to not catch a falling knife. You want to follow the trend. But the trend says, if you're following the trend says don't buy bond because SVN is going to keep dropping. What Beanstalk does, their mechanism, when the peg is on point, it has you commit to be able to support the protocol. That commitment is already made and is in place. That's what the credit is. So basically it says, hey, you want some of these rewards? Well, they take half the rewards and they send them to what they call Beanstalk the stock. And then they send the other half to what they call the creditors or the bean pods. And basically the bean pods is like they're waiting for beans. They're empty pods waiting for beans. They're waiting to get paid back. And because of that mechanism, then all they have to do is incentivize people to want to buy beans because every bean can be turned into a pod at a 1-to-1 ratio, but that pod pays an interest. And at times it pays a very high interest. And that interest payment is available when it's above peg. So let's just take a look at this.
Instead of using collateral, Beanstalk creates economic incentives to coordinate independent market participants to regularly cross the bean price above and below $1. Users of the protocol can receive rewards by helping to stabilize Bean's price through issuing credit to the protocol or providing liquidity. As long as Beanstalk is able to attract creditors, it can return the bean price to $1. By using credit instead of collateral, Beanstalk can issue enough beans to meet the ever-growing demand for stablecoins.
So let's look at this diagram quickly. When you see weather just means interest rate. When you see soil, it means how much debt they're willing to take on. So typically there's a lot more people trying to give debt, like you wait for soil. When it's available, you can buy pods. And once you buy pods, you're basically saying, hey, I want to buy $1,000 worth of pods. And the interest rate may say, you're going to get 50% on your pods. And what happens is those pods or your $1,000 gets put in a line to get paid back. You can see where it's at in line, and it will get paid back over time when the bean price is over $1. When it's over $1, new beans are minted. Half the beans go to the people who provided liquidity in ETH bean or in 3-curve bean pools, and that's inside of what they call the silo. And once it comes live, you'll actually be able to see it. The silo would be like M-share. The bonds would be like the creditors. So once the SVN, once it's over peg, that 2% per day that is paying out right now, half of that would come to people who've staked liquidity. The other half would go to the creditors. But notice, by using a credit algorithmic stablecoin, it encourages people to commit to the platform before the platform is in trouble. This prevents, this is exactly why the whole project is coming back. The amount of people, there's over $100 and something million. I told you at the beginning of this video, there's over $100 and something million in credit that was staked on the platform. That's a lot of people that now have a vested interest to want to be able to see this project succeed. I genuinely believe that's the only reason they've been able to raise money, or they're going to be able to raise money to restart this protocol. The credit model is brilliant. When the price is above $1, weather decreases, meaning interest rates decrease. They don't need to take on as much debt. New beans are minted based on whatever the price was. 50% of those beans go to the silo or go to the people who were staked. What I haven't talked about here is the Beanstalk portion. We'll get to that in a moment. 50% of those beans staked goes to the pod investors, meaning the credit line, the protocol loans. The bean supply has been increased. The price will go down because invariably some people will sell. Once the price is less than $1, interest rates go back up to encourage people to want to lend to the protocol. Soil goes up. So at the end of an epoch, basically there's soil there so people can lend or they can buy bean pods. They can lend to the protocol. More beans get sowed to pods, meaning more beans. You have to have beans, by the way. I said $1,000 worth is $1,000 worth of beans. You use those beans once they're soil to buy pods. When you buy pods, you basically wait for them to get repaid from this 50%. You wait in line. One guy put in $30,000 into this protocol, and I want to say he said he got out $150,000 when his pods, when they came due. He happened to use his beans to buy pods when the weather was really high. When you buy pods, you're basically taking beans off the market. So it decreases the supply. When it decreases the supply, it helps push the price back up ever so slightly to get it back to $1. And the cycle can rinse and repeat that way. And the whole goal is to keep the bean price closely pegged to $1. There's another mechanism in here in the silo. When you're in the silo, again, it's a little bit like being in M-share. You get 50% of the rewards when it's over pegged when you're in the silo. The thing about the silo, though, there's no share price. When you're in the silo, you collect a certain amount of stock, and that stock has its own APY. The longer you stay in the silo, the more stock you get. It grows over time. But stock is not a sellable asset. It is not a token. All it does is it's a representation of how long you've kept your funds in the silo. Whenever you come into the silo, you get some stock and it continues to grow over time. And in the first few weeks or first few months, it actually grows faster than it does later on. It eventually kind of slows down. There's a bit of a curve on how fast you get stock, and it kind of slows down and almost plateaus. What that happens is when you pull out of the silo, you lose all of your stock. So if you want to be able to own a big portion of the earnings in the protocol, then you go into the silo with your beans, you lock up your beans, and you collect stock for being locked up. And the longer you're locked up, the more stock you're going to get. So it incentivizes people to stay there. and you don't have the price fluctuation of this M share. When the SVN loses peg, M share price drops. It's very difficult. That's a strong market sentiment to expect people to suddenly say, oh, I'm going to go buy bonds. I know I've been there. One of the most successful projects I was in, I probably 5x my money within about a month. And I thought I was going to jump into bonds. I fully intended once they lost peg, I was going to jump into the bond section. And this has been 2 or 3 years ago. But I got to tell you, I think I had made like 20 grand on that thing within inside of a month. I think I tried to put $1,500 worth of bonds and I never ever cashed them out. I think the protocol collapsed. As bullish as I was when it was doing well, I thought I was going to drop in like $10,000 in the bonds because I figured I did not know the weakness of these algorithmic stablecoins. And since I've seen that project collapse, I've seen many other projects collapse. It don't mean you can't make money with these things. It just means they historically have a lifespan unless there's somebody around who's going to support the peg that's a centralized authority. They can't be fully decentralized. Where Beanstalk had been working fully decentralized, the economics of it had been working fully decentralized for many months until this exploit. And I'm hopeful that it can continue to work for many months and many years in the future. I think this model offers a lot of promise, and I'm excited to see it do well. Let me know down in the comments, do you think that we need a fully algorithmic, non-centralized stablecoin in crypto? Let me know down in the comments, ladies and gentlemen. Ladies and gentlemen, I'm excited to see where this goes, and I'm excited to be a part of this project. Part of crypto is knowing that even though we're in a high-risk area where we can potentially lose money, we are truly, truly on the cutting edge of technology, the cutting edge of finance. And when it goes well, it can really go well, not only just for us and our financial gain. Projects like this truly can make improvements in humanity, or at the very least, components of this project. Maybe Beanstalk doesn't succeed. It's kind of a silly name anyway. Maybe this project doesn't succeed long term, but maybe it succeeds long enough that components of this can be used one day. Maybe it becomes something even better. Who knows? Or maybe the DAO votes for it to improve in such a way that it's far better of a protocol than it is even today. I love this space. I'm excited to see what happens, ladies and gentlemen. I hope you're just as excited as I am. Decentralized cryptocurrency equals freedom. This is Crypto Wealth. I'm out.